Please welcome Jason and Garin to the S4 main stage.
This makes me feel way cooler than I actually am in real life. So thank you very much for being with our session. We do have some slides that we'll show with you. And then we're going to break out into a real good conversation about examples that we've seen in industry where people have succeeded in this conversation right here of linking the CISO to the CFO. So why would we want to do that? We know the CFO's got the money, right? But we've been talking about cyber risk and their risks in very different terms. One of the things that we'll talk about is how can you break that barrier and actually relate to them in a way that they understand. So one of the conversations that I think was awesome from Richard's talk earlier, so I'm going to preface this. We did not in any way collaborate with Richard on slides. So when he said, what is your risk tolerance? And this is our first slide, I was like, perfect, awesome. This is a conversation that happens a lot, that security leaders, when we talk about cyber risk, we are stuck in a world of defaulting to high, medium, and low, or red, yellows, and green. And we complain about it a lot. So I think that being able to start the conversations this morning on how do you quantify cyber risk is going to be a real big tell in the conversation we're going to have today about linking that back to the CFO and what it is that they care about. So how do we start with this conversation, Garin?
Before we determine your risk and address it, I think we need to do some level setting. So I want to talk about the different cyber perils.
So I'm going to side note on one. The first time I had an insurance conversation coming from the ICS security space, and somebody said, cyber is a peril. And I was like, yes, I have been doing this for a dozen years. This is very perilous work. Peril. We completely talked past each other because I didn't actually understand that we were talking about a term of art in the insurance side. So when you say peril, what do you mean there?
Yeah, most insurance policies are written to respond to a loss from a specific type driver, a peril. Fire, flood,
Earthquakes, natural disasters.
Cyber is kind of an interesting, a little bit of a super peril in that it results in a couple different impacts that can actually span a number of different insurance policies. So it can be tough to get your arms around where am I going to get coverage for different types of loss, all from this one cyber event scenario. But if you can get your arms around it, insurance is, as we're going to talk about, a powerful control to help manage that risk.
I just love that you said that cyber is a super peril. All right, so the conversation we're going to have when we link this idea of a peril is something that we actually do a lot in the ICS security space. We do tabletops, right? We walk through scenarios. In any given cybersecurity program, we know what a bad day looks like, and we exercise for it. At least we should be. So when we talk about this, this is something that really resonates in the insurance conversation that we're going to talk about in a little bit. And then what we're going to close out with today is actually taking those scenarios that we've seen on the client side and actually working with folks and how they've used insurance to respond and trigger and link back to what the board executives and the CFO mostly care about. So again, there's no collaboration on this, even though you can get a book signing later for how to measure anything in cybersecurity. But how do you measure anything and then do something about it? What's the next step after you quantify? And if you're quantifying cyber risk, who do you talk to about your quantification measures? So we're going to give you an actionable tool so that you can actually, at the end of this session, go back with and start talking to executives, boards, directors about what you want to do for a cyber risk measurement platform and how you go forward with it. Again, a lot of this can be managed with Excel spreadsheets. This isn't rocket science. I believe that was said earlier today, too. It is something that we actually have the data for and that we can do. It's not a big data problem. As a matter of fact, I love small artisanal, small batch data. I think you get the most results out of that. But you have the data already that we're going to tell you about that when you apply that cybersecurity lens to it, you could already have this conversation. So what do we start and what does this look like? So yes, risk is a curve. We've heard this before. This risk curve looks a little bit different than I think every other risk curve you've possibly seen. We normally see one that's kind of going off the charts in the other direction because we know that threats are increasing, we know vulnerabilities are increasing, and because we are getting more technology embedded into our ICS environments, we also know the impacts are increasing too. But when you take that idea of risk and you apply a cybersecurity capability discussion, how mature are your capabilities? How many capabilities do you have that you can trust and verify? Then you can start talking about actionably decreasing risk. Risk does not have to be a bad conversation. So very early on, you're talking about whether or not you have, let's say, an incident response plan. If you're all the way on the left side of the curve, early capability improvements are going to be the most actionable thing to decrease your risk. However, over time, you're going to have this notional idea of flattening out on the risk curve. We know our budgets are limited. We're not gold plating cybersecurity. We don't have unlimited budgets. So at a certain point in time, we have to talk about what that acceptance and toleration of other risks are, and we flatten out. We can only improve so much. It's at that point that we want to talk about cyber insurance. Cyber insurance is a financial control. So we talk about technical controls a lot in cybersecurity. There are financial controls, and this is the only control that will pay for itself during an incident. You want to have a forensics firm come out on site. If you have the right insurance policy in place, that will get paid for.
Not only that, it doesn't have that decreasing return on investment. It moves the entire curve lower. Just like you can't have gold-plated security, though, you also can't transfer risk without basic capabilities. If you're on the top left side of that curve and you're trying to buy cyber insurance, if you do find someone to take that risk, it's going to be prohibitively expensive and probably not serve you well. There are some parts of risk that just can't be transferred and you need to address.
And we'll talk about that in a little bit. What you end up getting from this curve, though, is the initial investment capabilities versus sustaining capabilities and investing in transfer. So as part of this conversation, we have technical folks, security team leaders who are talking in the bits, in the programmatic improvements that we do, and we want to talk to the CFO. But there's also another person there that you're going to want to talk to that you may not know who they are, and they're called a risk manager. And a risk manager may not be what you think from an enterprise risk management perspective. There's a sole responsibility at many organizations to buy insurance. And in some cases, they may already bought cyber insurance. I've unfortunately worked with clients, though, where the risk manager who bought the insurance never talked to the OT security team. So in that case, the cyber insurance was fantastic. It covered everything to deal with credit card monitoring that was not in their environment. This was a client that had no credit cards that they were processing, but they had insurance that covered credit card monitoring. So what we're going to do for you in the next little bit is actually break down the language for you to be able to talk to that risk manager, this mythical person that if you don't know who they are, one of your tasks after the session is to go back to your organization and find out who they are and talk to them about OT security.
So one of those terms of art is trigger. Triggers are simply the words which describe the perils for which coverage is provided under the policy. That portfolio of insurance you may have might have different triggers. If those triggers aren't aligned, or even if they are aligned, if the substance of them, what they describe, isn't aligned to your expectations of risk, you're going to have a gap in the insurance program, and that's going to be a problem. So security failure and privacy event are two of the more common triggers you're going to find in a cyber insurance policy, and they are defined terms which essentially reference unauthorized access, unauthorized use, or failure to protect confidential information. Other types of policies for which you may get some coverage in a cyber incident, talking about professional liability policies, technology policies, kidnap, ransom, and extortion, or even a property policy in some cases, they will also have triggers. They're not going to be nearly as specific to information security concepts, but it's important to read the policy and understand them to see how they all align for the big picture. So I'm going to take a seat, and Jason is going to show us a neat tool to help navigate cyber risk and how it maps to the insurance side.
So what's interesting about that, right, is when we talk about cyber insurance, you may not be talking about one policy. To navigate these waters, you actually have to talk about several different policies that may enact across each other. When we're talking about balancing out cybersecurity and balancing and communicating back to a CFO, we know this conversation. We've had this many times before. There's no ROI on security. You're going to try to prove a negative. There are all these trigger concepts that we've had within the ICS community that hasn't had us have this conversation that is really important and we should start engaging more on. So how do we take this idea of cyber risks, where we are on the risk curve, and apply it to somebody who is going to buy insurance, who may have already bought insurance, who's buying insurance for property and casualty purposes, but maybe not looking from the cyber lens, or bought cyber insurance that may not be covering the things that you're most worried about? So we have this idea here for our cyber impact framework that we're talking about that is dividing everything into quadrants. So you can see on the screen here, very simple 4 buckets. If you can find a 5th or 6th bucket that you think should be here, I guarantee you it probably doesn't exist, but I'm open to new ideas. Because it's very large categories, right? There's first party, your organization, and third party, somebody else. Whether that's a customer, or whether or not that's somebody else in your supply chain, or whether or not that's a neighbor in the vicinity of your facility. We have financial damages and physical damages. Financial damages is anything that's coming out of your wallet, and physical damages are what we care about mostly in this ICS OT space. So, what does the cyber loss spectrum look like when we talk about those gigantic buckets? And this is where you're going to go through these next slides and be like, yeah, that wasn't rocket science at all. And yes, I do have that data, so why haven't I quantified this risk yet? So the very first thing in financial damages, these are the things that is well-worn territory. When you think about the typical events outside of the ICS community, Target, Yahoo, the events that have hit the news, but there was not any physical damage. There was no ICS component that was compromised. So in this case here, we know what response costs look like. We know what it takes to get a forensics firm on site to help us out with restoration. We know what legal fees are. Lawyers don't hide their prices. These are all things that you would expect to pay out during an event that you can quantify. The other things that you'd want to worry about is any lost revenue. And again, you know what you make on a daily basis. If you're only in the financial damages area, and we're not talking about ICS, that's easily quantifiable. The only thing here is a little bit weird is actually stolen intellectual property. That is very difficult to actually quantify, but insurance really doesn't want to have that conversation anyway. For myself, as CTO of Axio, I obviously have $5 billion worth of intellectual property right here in my brain, right? If you steal that, then I'm $5 billion off. Garin, will you insure my $5 billion?
No.
Okay. Damn. I was really hoping I could get something out of that. So stolen intellectual property is the only thing there that is a little bit funky, but everything else we can quantify very easily. Third-party damages. Again, these are others. In the financial world, we normally talk about credit card monitoring. This is the biggest culprit there, and we know how to model that too. As a matter of fact, we have what we call magic calculators online. You can go in, you can say how many records you have, whether it's personnel or credit, and somebody will say this is the type of impact you could expect by paying for credit card monitoring, and you then go to an insurer with that conversation as well. Now let's talk about the things that we care about. These are the things that when Garin talks about insurance as a history and what they've learned over time, we're relatively new to having the conversation with insurers as to what it is that we worry about from a property and casualty side of things. But we also know how to quantify this too, right? We know what your assets cost. We know what equipment breakdown looks like. We also know what property damage could look like. You already have a property policy that examines that. Same thing with environmental cleanup. Any revenue loss from you not being able to produce or provide a service is also quantifiable. You know that this facility, if you lost it, would be $50,000 a day. You can quantify that. Same thing with anything for bodily injury. We have actuarial tables that have this conversation. So this is nothing that is mysterious. These are things that you can put confidence behind a value on and have this conversation. Same thing with third party, whether or not they're your customer or a neighbor or somebody else that you would be liable to help them out with their mechanical breakdown or their property damage as a result of a cyber incident that hit your ICS facility. So when we take this, we can apply a new metric to it. We talked about scenarios. If you look at what we do in a cybersecurity program and team, as I said, we do tabletop exercises all the time. What we don't do is then apply a dollar value to that at the end of it. So if you go through and you say, I know what the cost of that asset is, I know what the downtime would look like, I can start talking about lost revenues. I can start talking about who I need to hire to bring on site to start doing that. Do I need to get actually a lawyer to help out with any regulatory worries that I may have as a result of that? And once you do that, you can start looking at the quadrants as a way to approach dollar values. The good thing about this, that Garin will talk about in a little bit, is that this all lines up to what insurance is looking at. So you can quantify easily. I don't have to worry about financial concerns or credit card monitoring, so I'm going to worry mostly about OT and ICS security. Or if it's a company that's only on financial lines, I'm not going to worry about the bottom parts. This intermixes back and forth, and it helps insurers be able to have that conversation. So with that, I want to leave one note as to why it is that we're talking about insurance. We talk about risk response a lot. And when we talk about risk response, for decades, we have talked about 4 things in risk response. Acceptance of risk, right? The things that we cannot change, we accept that risk as security practitioners. The tolerance of risk, again, that's if you don't have a budget for it and you already haven't had this conversation of acceptance, you can have this toleration of the risk that you want to discuss. But we always get fixated on the mitigation of risk, right? For most IT and OT security teams, we talk about acceptance and mitigation. There's still a 4th step here, that we've had this same slide and this same material out for decades. and that's transfer. And we've always talked about it, but we've never really triggered into why it is that insurance is that transfer mechanism.
So before I talk about today's insurance, I think it's important to understand some of the drivers and the history of how we got here. Insurance is a market. Just like any market, supply and demand drives things like capacity and pricing and availability. It's also a market that's pretty slow to change. As technology changes or as loss develops, it can take a year or two or maybe even more before you'll see changes in insurance policies to deal with that new type of loss or deal with that new reality of loss development. Example of this, in the 90s, property insurance policies were really underwriting only to and structured for tangible property loss. But there was one insured who said, I think, data is property. I would like coverage for my data. Nothing was smoking, burning. There was no tangible property loss, but they had a alteration or destruction of their data, and they sought recovery for that under an insurance policy. And because of the market demand at that time, they couldn't get the insurer to provide coverage for data on a going forward basis. All of a sudden, you saw exclusions pop up in property policies, excluding data as an asset that was covered under the policy. And you saw the birth of the cyber insurance market. There was more information, there was higher information requirements and more premium required to get that risk. Through the 2000s, we saw cyber insurance start to grow. One of the big factors in that was the rise of electronic breach notification laws. These new laws created liability for companies that they wanted to transfer off their balance sheet. And with the rise of that liability, we saw a rise in cyber insurance. Now, while there was loss development that the news has really talked about, I don't need to preach that, it was still very profitable. We saw there used to be a small handful of cyber insurers. There's now several dozen. And that competition, again, because it's a market, drove down rates and brought in coverage. So you really saw an uptake, a new evolution of coverages, which I'll get to. One of the things I think we'll talk about, fines and penalties. But I want to bring this back to what this community is worried about. And something happened in around 2010. I don't want to say the dirty S word, but it's important to understand how it impacted the insurance market. All of a sudden, carriers of traditional property and casualty said, maybe it's not enough to exclude data. Maybe I shouldn't even be covering tangible property loss if it arises out of a cyber incident. I'm concerned. The market was such, however, that a new product didn't really take hold. Carriers did that for a little while, and losses really didn't develop after that for these cyber physical losses. And you saw some carriers say, all right, I'll put it back into the property policy or the casualty policy. You saw other carriers say, I'm going to create a new generation of cyber insurance products to deal with those tangible risks, which they previously hadn't. That continued for a little while. You even saw some property carriers go back, and undo what they did 15 or so years, 20 years prior, and start to provide coverage for data again, even when there was no associated tangible property loss. It wasn't a fire that consumed your data center and some data got lost. It was just alteration or corruption of your data because of, say, malware. They started to provide that coverage, which gets us to today. We just had NotPetya and other big ransomware events, and all I can say is that it's a market in flux. Some of the property carriers who had decided to provide coverage for data are reconsidering that notion now. So that brings us back to the cyber impact framework, which, as Jason mentioned, is great for us in insurance because it really helps us match up those coverages, those exposures to the coverages we provide. So cyber insurance policies that have been around for 15, 17 years really do a good job of matching up against the top half of that quadrant, those non-physical cyber exposures. They're more than just data breaches. They've responded well to things like Target and Home Depot and Anthem, but they also provide coverage for availability, denial of service attacks. They've even expanded in some cases to non-malicious incidents, systems failures. The key limiter that I think this community is very, obviously very focused in on is they're still, 99% of the time, they're still subject to that exclusion for bodily injury and property damage. So traditional property and casualty policies where you'd expect to get coverage, first-party coverage under your property policy for damage to a tangible asset, or coverage for liability because you cause bodily injury to someone or you damage their property, hit or miss. Some of them, particularly in upstream energy markets, are actually are excluding cyber absolutely, even if that results in mechanical breakdown, something that you'd expect to get coverage under a property policy for. So it's a market in flux. And then we're seeing a few carriers, shifting boundaries. As I mentioned, some property carriers are willing to provide coverage from data. You see them gravitating from that lower left-hand corner and starting to encroach on that top left side. You're also seeing a select number of cyber insurance carriers who have really only been financial lines players starting to creep down and provide coverage for physical losses. To me, this is a little bit like asking the Maytag repairman to service your Tesla. It's not necessarily their forte. Some buyer beware there.
What's interesting to me about that is being in the ICS community as long as I have, we've talked a lot about convergence of IT and OT, and independently in another industry entirely, you've been trying to deal with this exact same problem. You have this convergence of people who are from the financial lines IT space, trying to come down into the property world, and vice versa, engineers that are trying to say, well, what can we do to talk about cyber insurance? And so the blurring of the lines, I think, is actually a really interesting thing to see another industry do when they're talking about converging the spaces together.
Yeah, I really want to get to some of the examples, but all I can say now is that there's no consensus among insurers. Some believe that the entire spectrum of cyber impacts, that whole quadrant, including some of the physical stuff, should be covered by a cyber insurance policy, which today most of them exclude bodily injury and property damage. There are some that say financial lines underwriters, they couldn't tell the difference between a 1 megawatt generator and a relay versus anything else. That really should be part of the engineering and the property insurance coverage. So it's a market in flux.
So what's interesting about that is that if we take these two concepts, right? So Garin just walked through all the different types of policies that would cover everything within the quadrants. So if you go through as an organization, do a tabletop exercise where you quantify for the scenarios what your cyber risk, what your cyber impact would look like, you can then create another metric on top of the old one, where you take all the things that you know you'd be suffering under that event that you'd have to pay for, and actually apply it to what your cyber insurance would cover. There are clear delineations on triggers, and there are clear limits as to what it is that you would actually be able to get reimbursed as you go through every single category. So in this example here, you could say that somebody's lost out on this conversation of what to do about their own property during a cybersecurity event because they may not have had the right coverage tailored to that incident. So we're going to examine into a little bit more deeper of what it means to talk about cyber insurance. And we're going to start that off with just very easy myths versus reality that everyone has heard at some point in time when having an insurance conversation inside your organization.
And in some fun role reversal, I'm going to do the myths.
And I'll do the debunking.
So the first one, cyber insurance policies have strict requirements that need to warrant coverage.
Totally, I mean, that's not false. There are some insurances that do have that, but if you have that type of policy, you may have the wrong policy. You've not gone through that tailoring process.
And that's something that really hasn't existed for a number of years. A lawyer may have told us that we need to put may in there, but feel strongly that mostly, not really a thing going forward. Cyber insurance does not cover ransomware.
Totally, it's readily available. Totally false. Not only will it cover for any ransomware losses, but they'll actually cover for payment too. So anything that you may have to do with Bitcoin, you can actually get covered within an insurance policy.
Cyber insurance doesn't provide coverage for a rogue employee scenario or an error.
Big if true, but it's false. Employee sabotage is readily available. Insider threats, we talk about a lot as something that we're worried about in the OT space, and you can get coverage for that.
But Jason, cyber insurance is really only useful for data breaches. It only covers notification costs and monitoring.
So luckily, you just saw all these slides that we just talked about that goes through the policies cover things that we see in the ICS space regularly.
Oh, gosh. I'm sorry. Cyber insurance doesn't pay. Or take all your money.
So it's funny. So when we were doing the role reversal, I was like, this is funny because my response would be like, I know that Garin has to deal with payments. So insurers do pay. And any stories that we typically see has been somebody who's not gone through that tailoring effort. They just have a policy because somebody else bought it and they didn't go through the what do I need to actually quantify for and what are my triggers that I'm worried about.
Yeah, at AIG, we pay $70 million in losses, not only cyber, a day. The problem is we generally can't talk about our successes. You only hear about the disputes between insureds and insureds. But if it's a product that we aren't paying, it's a product that isn't growing and isn't worth selling. The trick is understanding the losses, and we like claims. The last one, finally, isn't cyber insurance an admission of guilt?
So the admission of failure conversation is really interesting to me. If you go through this conversation where you do a tabletop, you quantify your risk, you go back to executives and you say, here's what we've quantified, here's what we're covered for, you've actually managed that problem. And would you rather manage that problem and be able to have that conversation, or would you rather go to the CFO during an event and saying, so I need about, I don't know, $500,000 for a rainy day fund to be able to get a forensics firm on site, help me out with this problem, and get us back into operations. It's a management of the risk conversation that you want to have, not that you've somehow ignored it or not used the tools that we have readily available. So we've now taught you Kung Fu. So why don't we go through, we don't really have a fire here for fireside chats, but we have two examples that we want to be able to bring everybody into where we've actually had this conversation with clients and seen how their insurance has responded. So Garin, I know you've got a disclaimer actually before we do that.
Yeah, I want to bring real lessons learned to this community and share them so that we can learn from them, but I also have to be fair to our clients and have to respect their confidentiality. So I've obscured some details that we're going to talk about, and some unimportant details I've actually swapped out to preserve anonymity. That said, the lessons learned are real.
All right, let's start. So an industrial and manufacturing client that we've worked with before.
This scenario revolves around NotPetya. Their industrial control system operations was compromised, and they were unable to conduct manufacturing operations.
So their production line just stopped.
Yes.
All right. Sounds like a fun day.
Not a fun day. We're talking about in terms of impact. You have to have the forensic investigation to understand what happened. Was this some kind of systems failure, operational error, or is this actually attack? And can we fix things and bring it up again without it happening again? Obviously, you might need legal representation depending on what other data was touched, and the loss of revenue is another big impact.
So loss of revenue here is listed out twice. What in the insurance world gets triggered on different loss of revenue discussions? Because we in terms of modeling that's a big one.
Yeah. Again, one of the key limitations of cyber insurance policies as they've existed for the past decade and a half is they're subject to an exclusion for bodily injury and property damage. So a cyber insurance policy would typically pay for loss of revenue, income, in a standstill operation or denial of service attack where there is no tangible property damage. In contrast, most property policies, they require damage to tangible property. So if there is a fire, flood, or explosion, and then as ensuing loss, you can't conduct your business, they will pay that business interruption loss. Seems kind of odd that we're sort of in a pray for fire scenario, but in this particular NotPetya incident, there was no tangible property damage, so it might not trigger the property policy.
Because the assets are still there, they're physically there.
No mechanical breakdown, no fire.
And so in this case, for this particular example, the client had the appropriate insurance, right? Or
they bought a traditional property policy. They did not buy cyber insurance. However, as mentioned, their property policy was one that extended into that top left corner. So they had the language which addressed the exposure. They had the right trigger. However, they didn't buy enough limit. A property policy might be anywhere from $100 to hundreds of millions of dollars, but where they do provide coverage for alteration or corruption of data because of a cyber incident, it's usually a much lower level. In this particular scenario I'm thinking about, they probably would have been better off with some cyber insurance, which would have been more than enough to address that exposure.
So if they had a fire, hundreds of millions of dollars of coverage. They didn't have a fire, so tens of millions or millions of dollars to respond when they had lost revenues, other projections that brought them up higher.
Because of the way coverage falls across these quadrants, yes, and how policies are constructed today. That's one of the arguments for having a all-encompassing cyber insurance policy versus kind of the patchwork that exists today.
Treating it as a peril. All right, so that's production. Utilities are more service-oriented, power, water, et cetera. We do have another example that we've got a little bit of time to be able to go through. The clock is ticking. So let's walk through this one a little bit.
I'll be quick. So this was a SIP-regulated utility who had a targeted ransomware incident. And luckily, it did not directly impact ICS operations, but it did indirectly. Without, the IT side was locked, and without the ability to pass on service requests, find out where outages are and route appropriately, or to pull data out of the ICS environment for regulatory reporting or management. They had to find out how this got in. They needed legal representation. There was some extra expense, if not strictly income loss. There was extra expense, so a loss of income. And then on the liability side, customer data was potentially impacted. All the stuff in the top right-hand corner.
So to clarify, even though the assets that were impacted were not the NERC SIP assets, we're not talking about a reportable event or anything like that. It did not impact reliable operations, but they had an incident that they had to respond to. If they had an incident that, let's say, did go through that, and they had to deal with NERC penalties, is there anything additional that insurance would be able to have a conversation with them about?
Yes. So part of the evolution that I spoke about earlier, cyber insurance generally covers fines and penalties now. This started, state attorneys general, Department of Health and Human Services, but it has extended to even NERC SIP fines. Two caveats I want to be clear about. One, there still has to be, you still have to have that triggering event that we talked about earlier. So it can't just be an auditor on site, you're not compliant with SIP.
That can't be a triggering event as an
not
auditor.
a triggering event.
Going through an audit.
However, if there is some type of security failure, some type of incident, and there is a SIP fine on top of that, that would, the intent is to cover there. And second, the regulator always gets a vote, or the enforcer of the fine. So always a question with insurance. We intend to cover it, but is the fine insurable? That has not been tested yet.
Got it. So in this example, we didn't have anything that kind of went down into the property area, but this client had cyber insurance, and so this targeted piece of malware was actually dealt with from their policy, correct?
Yep, and if they had a kidnap, ransom, and extortion policy, that also probably would have triggered and provided some coverage for that top left scenario. There's a number of coverages. Had there been a failure, had it crossed the line into the ICS environment, and there been a failure of safety systems, and God forbid someone had been injured, the cyber insurance would have done nothing. They would have cited that bodily injury and property damage exclusion. And that's where you need to look to your traditional casualty policy or one of those newer generations of cyber insurance policies that are intended to cover the full spectrum of cyber loss.
Awesome. So with that, we're kind of treating this as an achievement unlocked. You've now got a new tool in the toolkit. There was, again, nothing rocket science about what we just discussed. Just like any security control, technical or procedural, you have to tailor it to your environment, right? You don't take a firewall, industrial or otherwise, and just put it into your system and say, okay, well, I don't have to worry about that ever again. You need to go through and make sure that it's responding to what it is that you need it to respond to. financial controls, insurance included, are the exact same way. You would not do this with any other security control and not tailor it. So you shouldn't expect that from insurance perspectives either and say, well, I've got insurance, so we're covered. You may not be. So you really need to take this, tailor it to your systems, go through tabletops, quantify as you go through with it, and then go back and have this conversation with this mystical person called a risk manager in your organization who will actually go out there and buy insurance to cover these types of things. Or worst case scenario, they already bought insurance and you do not know what's covered because you weren't involved in that conversation. So with that, there's a whole bunch of disclaimers, but thank you very much for your time and consideration.